In this video, we're going to look at determining inventory cost. Now, that's a function of two things. Getting the count right at the end of the accounting period. I count what's left unsold. I've got to get that count right. And I showed you in the last video, if you got the count wrong, then you have the income statement wrong that year and next year, because the ending inventory in one year becomes the beginning inventory in the other. Here we're going to talk about what price do I put on the value of the inventory I sold. For example, let's assume I had purchases in this fashion. I started off with 10, I purchased another 10 March 2nd, March 28th, May 28th, 20, and so on. I have 80 available for sale. Now, during the year I sold, March 10th I sold these 10, then I sold those 20, and so on. But which 10 did I sell? I don't know which inventory I had available. I know I had 20 available here in March, and I sold 10, but I don't know if it's these 10 or these 10 or 5 of this, 5 of that, or 6 or 4, what have you. I don't know the value. Same with July 14th, I sold 20. I don't know if it's part of these or part of these up here. That's the problem. But I do know I sold 60 and I have 20 available. So I must assign the cost in a certain way. And there are 4 ways of doing it. Number 1, specific identification. If I had barcodes, then I would know exactly which ones I sold. So I wouldn't have to assign the cost. So specific identification means I have no problem identifying what is sold and what is left in ending inventory. Now, because prices went up and down during the year, I could do a weighted average method, but that's neither here nor there. Nobody uses it. What companies use is either FIFO or LIFO. Now, FIFO assumes that sales were made first in, then I purchased, were the first out that I sold. Therefore, what's left in ending inventory are the latest purchases. Or the company can assume a LIFO. That is, the last ones that came in were the first ones out. Therefore, the ending inventory were the old ones. Well, let's go through an example. If we did FIFO, and we have this situation with rising prices, as you see, we assume the first ones in were the first ones out. So we sold 60. So it was this 10, 20 here, 10 here, and 10 of this. So therefore, the ending inventory would be the remaining 10 October 12th at 880, and December 21st purchase of 10 at 910. So therefore, we would say the ending inventory is 179. That's the value I would put on it. Therefore, the cost of goods sold, I had available for sale 690. I have ending inventory of 179. Therefore, the cost of goods sold would be 511. That's what I would say. So 511 would go to my income statement as cost of goods sold. The 179 would go to my balance sheet as the value of the ending inventory. That's if I was under FIFO. If I'm under LIFO, I'm assuming last in were the first sold. So of the 60 sold, this 10, this 20, this 10, this 20, and what remains are an ending inventory are these two. So therefore, I would say the value of my ending inventory is 10 times 8, or 10 times 850, which means 80 and 85. I would say the value of my inventory is not 179 as it is under FIFO, it's 165. And therefore, the cost of goods sold, 690 minus my ending inventory of 165, I would say that my cost of goods sold is 525. So you see, I have a higher cost of goods sold under LIFO than I have under FIFO. So I'm going to show a lower profit under LIFO than FIFO. So FIFO gives me a lower profit. However, the trouble with LIFO is the replacement value of the inventory would be closer to $9, not $8. So the value of the ending inventory is actually low here. So you see, LIFO gives you a reasonable reasonable income statement, but a faulty balance sheet, because what they're expensing in the income statement are the latest purchases. What they're holding back in ending inventory really early is, which is the opposite of FIFO. Now, most companies use FIFO because it gives you a higher net income. Governments say we don't care what you use, FIFO or LIFO, but once you choose the system of LIFO, you must consistently use that so that all your income statements year after year are comparable. Same thing with FIFO. If you choose FIFO, you use it consistently so all your income statements are comparable. Because you can see that if you switch between FIFO and LIFO each year, you are manipulating your net income because of the inflationary impact on your inventory.